Bitcoin is famous for its absolutely wild price swings. It's what it does. So why has it been so quiet lately? Today, we're going to dig into what this unusual calm might actually be a quiet warning sign for the entire market. So here's the deal. For the better part of 2 months, Bitcoin has basically been flatlining. Seriously, it's just been trading in this surprisingly narrow range, which, for an asset known for its crazy volatility, has a lot of analysts scratching their heads. And yeah, that brings us right to the heart of the mystery, doesn't it? Why has Bitcoin, the absolute king of volatility, gone so quiet? Is this just the calm before a massive storm, or are we looking at some kind of new normal? Let's figure it out.
Okay, let's start with Section 1, what we're calling Bitcoin's Big Sleep. Here, we're just going to look at the evidence that shows just how deeply this market seems to be hibernating.
And to put some actual numbers on this, the price has been pretty much trapped between $29,000 and $31,000. Now for Bitcoin, that is an incredibly tight corridor to be stuck in for this long. It's just not normal. And this number right here, 43, it tells the exact same story. This is Bitcoin's implied volatility index. Think of it as a way to measure how much traders expect the price to move in the future. And a score of 43, well, that's incredibly low. It signals that the market is basically betting on things staying calm. In fact, it's not just low, it's an extreme multi-year low. This tells you everything you need to know about the market's current mindset. Traders are betting that, nothing big is going to happen anytime soon. No major catalyst, no drama, just more of the same old, same old. So why does pretty much everyone think nothing is going to happen? Well, that brings us to Section 2, the market's official story. This is the consensus view, the thing that seems to explain all this quiet. And this whole story, it pretty much revolves around one thing, the U.S. Federal Reserve, specifically the chance of a rate cut. And just as a quick refresher for all of us, a rate cut is just when the central bank lowers interest rates. It makes borrowing cheaper, it's meant to juice up the economy, and it's a huge deal for markets, especially crypto. And here it is. This is the key piece of data driving that consensus. According to the CME Fed Watch tool, which is a really widely respected indicator, the market is pricing in only a 5% chance that the Fed will cut rates at its next meeting. 5%. That's next to nothing. So the bottom line is this. The official story is that the Fed isn't going to do anything. They're just going to hold steady. And if that happens, there's no major economic catalyst on the horizon to shake things up. This belief, it's the anchor holding the entire market in this quiet state. But is that story actually right? And this is where things start to get really interesting. In Section 3, we're going to look for the contrarian clues. The cracks that might just be forming in this official story. And the answer seems to be, yeah, they are cracks. The Fed is dealing with some deeply conflicting data right now. On one hand, you've got shockingly weak job growth, which would argue for a rate cut. But on the other hand, inflation is still stubbornly high, which argues for holding steady. It's a classic catch-22. They're stuck. And if the economic confusion wasn't enough, there's a new variable in the mix: unprecedented political pressure. As Derek Lim from Caledon points out, it really seems like the government is trying to influence the Fed in a way we just haven't seen before. And that complicates an already really difficult decision. So, because of all these factors, some analysts are starting to push back. They're saying, hold on a second. Sean Dawson from Derive, for example, thinks the real odds of a rate cut are probably closer to 10%. That's double what the market is pricing in. He thinks the market is just fundamentally underpricing the risk of a surprise. So what do you have? You have a market that's fast asleep, totally convinced nothing's going to happen. But just under the surface, you've got this conflicting economic data and these new political pressures creating a very, very tense setup. And it's all leading up to one single key event that could just break everything wide open. And that event? Well, that's the focus of Section 4, the inflation catalyst. This is the moment of truth, the one thing that could either confirm the market's calm or shatter it completely. And the sequence of events is actually pretty simple. You start with what we have now, extreme market complacency. Then, the key inflation data, the Consumer Price Index, or CPI, it gets released. And depending on what that number is, the result could be a truly explosive market reaction. And that brings us to the big reveal in our final section. What makes this whole situation so unique and so interesting is what traders call an asymmetric bet. Asymmetric risk just means that the potential outcomes aren't balanced. It's not a 50-50 thing. One possible outcome has a much bigger impact than the other. Think of it like a situation where the potential upside is huge, while the potential downside is pretty small. Okay, so here's how that asymmetry plays out in this exact situation. If the inflation data comes in high, which is what everyone expects, the market will probably just shrug, and Bitcoin will keep trading sideways. No big deal. But if that data is soft, if it shows inflation is actually cooling, it could catch everyone completely off guard and trigger a really sharp rally. And hey, don't just take my word for it. Experts are seeing this exact same setup. Quinn Thompson over at Lecker Capital says that the risk feels asymmetric because the market is already priced in that no big deal scenario so heavily. The real risk and the real opportunity is in the surprise outcome. So the crucial point, the big takeaway here is this. The market's deep complacency is the very thing that creates the potential for a massive move. Because almost everybody is positioned for calm, any unexpected result, like a softer inflation reading, could force a rapid, maybe even violent reaction and send the price soaring. Which leaves us with one final question to think about. We see the low volatility, we see the conflicting data, and we see this really interesting asymmetric setup. With so much riding on a single data point, is the market's quiet confidence a sign of wisdom? Or is it just ignoring a massive warning sign?